What is the most controversial theory in finance and efficient market? Does it hold or doesn't it hold? If it holds, does the weak form hold, or the semi-strong form hold, or the strong form hold? People have studied this left, right, and center. Even today, in this institution, School of Business, many students do their MSc dissertations on efficient market. A lot of third-year students do their third-year dissertations on efficient market. What do they do? PhD students are still doing PhD in efficient market. And how do you test for these things? Can you all see that? Is it visible? The light is too bright for my face. There are two ways to run the weak form. One is autocorrelation test. So remember the weak form. Weak form says that you cannot use time series or past history of the prices to forecast the prices tomorrow. So you cannot look at the prices from Friday and Thursday and Wednesday last week and tell what the prices will be Monday morning when the market opened 1 hour ago. Or look at today's prices and say what the price will be tomorrow or day after tomorrow. That's the weak form of efficient market. You cannot use historical series or historical data of prices or volume of trade or anything and make a forecast or prediction of what the price will be in the future. And how do you test for that? There are two ways to do it. Look, one thing is to look for autocorrelation. What's that? Any conversation? You basically look for the correlation between price today and price tomorrow or price yesterday. That's today, price P naught, that's yesterday, price -1, and that's tomorrow, price 1. If you cannot use this, price yesterday -1, if you cannot use this to forecast today by weak form of efficient market, you cannot use this to forecast that. This is already gone. This is today, and that's tomorrow. If you cannot use this to forecast that, you cannot use that to forecast this, then there should be no correlation between these guys. Remember what correlation is? Something we did 2 weeks ago. We did two things, covariance and correlation. Remember correlation coefficient? That goes between -1 and 1, and covariance that goes between -infinity to positive infinity. What does covariance show? Anybody remember? What does correlation coefficient show? Yes, ma'am.
The relationship between two assets.
Yes, the relationship between two variables. Remember covariance? Covariance between x and y goes between this and that, and correlation coefficient with x and y goes between 1 and -1. If they are positively related, they move together, 1 and 1. X goes up by 1%, Y goes up by 1%. Come on, I've done this. Don't look at me like you've never seen this before. Everybody's looking at me. That's one to one relationship, and this is -1. So we did 3 cases, remember? 2 risky assets, A and B. What happens to the variance and return when the correlation is -1, +1, and 0? The 3 efficient frontier, the straight line, the bullet. We did this. That's we test for. If this guy has no effect on this guy and this guy has no effect on this guy, then the correlation should be 0 and the correlation should be 0. They should not be related to each other. The correlation coefficient, the correlation between P naught and P1 should be equal to 0. Similarly, the correlation between P1, P naught, and P -1 should be equal to 0. There should be no relationship between these two and these two. If there is a relationship, that means P naught affects P1. P1 affects P2. If there is a relationship, and you can figure the relationship out, the find out the correlation is significant and it is 0.2. That means P naught affects P1 by 0.2. If P naught goes up, P1 will go up by 20%. If P0 goes down, the P1 will go down by 20%. If you can figure that out, you know what the future price is going to be. If the price of British Airlines today and tomorrow is up is 20% relationship, 0.2, you know what the relationship is going to be. Anybody can make money there all the time. Remember, efficient market does not say you cannot make returns, or it says you cannot make returns consistently. Efficient market does not say that you cannot make abnormal returns more than what CAPM says. What you should be making is the normal return, and normal return is described by CAPM, the CAPM equation, security market line. Security market line is what the returns you should make. To make more than that consistently, it's not possible. It is possible to make it now and then, but not consistently. That means there should be no pattern of any type. There should be no trend of any type. Stock prices should not move in pattern. Two stock prices should not be going up or going down at the same time, the same percentage every time. If that happens, there is a pattern, and investors will pick on that and make abnormal return every time. If there's no correlation, ain't gonna happen. It's not gonna happen. If P naught and P1 are not correlated, then you cannot use that forecast. There's no correlation. There's no relationship between the two. There's no relationship between price of British Airlines at this time, 10:15, and there's no relationship between price of British Airlines at 11:15. 12:15, tomorrow morning at 10:15. Correlation, and that's how you do one of the tests. The first test is you look at the correlation between the two. The second test is the run test. What's that? You take delta P. What's that? What's delta P?
Change in price.
The change in price. Delta P is basically P naught minus P minus 1, P1 minus P naught, P2 minus P1, things like that. This is P2, the day after tomorrow, P3, and onwards. It is a change in price. It is a change in price. The change in price between today and Friday. Yesterday was a Sunday, so the market was shut. The change in price from tomorrow 9 o'clock to this morning 9 o'clock. Or the change in price from 10:30 to 10:15. This is a change in price. You want to subtract the price. P naught minus P1, change over here, the change over here, the change over here, and the change over here. Going backwards also. And if you look at the change, first change is positive, positive, negative, and so on, things like that. What does that mean, positive, negative? Delta P. If I say delta P is positive, what's that supposed to mean? Price has gone up, right? If it is positive, that means P1 is greater than P naught. If this is true, that means P1 is greater than P naught. If this is negative, that means P2 is less than P1, right? So if it's negative, that means price has gone down. If it's positive, that means price has gone up. You can do this. You can look at the past daily prices of any stocks. You can look at the past daily price of any stocks. Take the difference between 10 a.m. price of British Airlines today to Friday, then from Friday to Thursday last week, Thursday to Wednesday last week, Wednesday to Tuesday last week. That's easy to do. These things are available. And you see the change in the prices day by day. 5 minutes by 5 minutes, week by week. You can do it any frequency you want, month by month. Well, these things are available every 5 minutes, every 10 minutes, every day, every few hours. You can download them easily, no problem now. In the olden days, you could read newspapers. You collect that, and the change in price should be what? Should be purely random. What does random mean? The change in price should not have a pattern. The change in prices should not have a consistent pattern. It's not that it rises 5 times in 5 days, then goes down 3 times, then goes up 5 times, then goes down 3 times, then goes up 5 times, goes down 3 times. It should not be a pattern like that. It's not that it goes up twice, then goes down 4 times, then goes up twice, then goes up 4 times, then goes up twice, then goes up 4 times. If you get a pattern like that, then you can manipulate that to make extra money all the time. You know when it's going to go down then. There should not be a pattern. They should be purely random. It should be all over the place. There cannot be a season or pattern to it. It should be all over the place.
But there's always patterns in the stock market.
No.
Like the January effect, for example.
I'm talking about that. That doesn't exist anymore. That's only a few. There should not be a pattern, but usually there should not be a pattern. If you find a pattern of a stock that actually is moving in a certain way, not random, but certain pattern, and you can figure the pattern out, then you can make consistently abnormal return above the security market line. That means that stock is not on the security market line, it's off the security market line. Now the security market line, everything has to be on the line in the long run. Everything here has to be on the line in the long run. When the market is equilibrium, all the securities have to be on security market line. You can be off for a little bit, but not consistently. You can make return, you can make abnormal return, but not consistently. You cannot make money off the same asset or any asset consistently. The return you can make is a normal return, which is based on capital. So the first one looks for a correlation between the two, and the second one looks for randomness. People are doing the efficient market asset, pay attention. Okay, semi-strong. What is an event study? Event study is a statistical method. It's a very old method, it's not new. It's from the 70s, even before you were born. To study the effect of an event, political event, financial event, company-oriented event, any event, on the reaction of the stock market, or the reaction of that particular stock. Now, by semi-strong form of efficient market hypothesis, the stock market should react to any event, whether it's anticipated or unanticipated, very quickly. If the event is anticipated, then the reaction should be very quick, because already in the investor's head what's going to happen tomorrow. So when the stock market opens, the behavioral finance says the investors will behave in such a way that the market will not react. Market reacts due to change in demand and supply. Price of anything, whether it's milk, cars, second-hand cars, brand new cars, your clothes, education, stock market, bond market, anything. Stock prices react due to change in demand and supply. And whose demand and supply? By investors. Who are investors? They are people. And they move the psychological effect. Behavioral finance says, if the event is expected, there should be no reaction in the stock market. If the event is not anticipated or not expected, it happens like that, then it should react, but it should come back to normal return very quickly, or relatively quickly. Elections. One of the things people study in event studies is elections. So events can be anything. What's the date today? 2nd of November? That's a few days. Monday, Tuesday, Monday. taking place here? Election of the country. US or UK, doesn't matter. You really don't know the results till the results come out. Right? Then the results are announced late night or early morning here, whatever. You really don't know. How will the market react here? Reaction of the market. How will the market react? That's what event studies study. That's what they do look at. Now, account efficient market, if the election result is expected, Cameron will win again, like it was last time. Will the market react differently or react at all? And if the result is completely unexpected, we have no clue who's going to win. Some elections are like that. The election between Bush and Gore, forget which year it was. It was up in the air. It was till the last minute, nobody knew who was going to win. Supreme Court had to decide who won the election. It was that close. It was the closest US election ever. How would the market react? So the two parties will have different effect on the market. One liberal and one conservative. The tax laws are different. They will change the foreign policy. They will change the different business policies. And the stock market reacts to that. So who will be the head of the country? But if the result is expected, because why? Because the polls are saying that conservatives are 20% ahead or 15 points ahead of the Labour, and Labour have no chance. It's a done deal then. The market should not react when the results come out that conservative David Cameron has won. But if the polls are still 50-50, how much you believe the polls is a different story. It's 50-50, and it could be anybody's game. The market will react differently. Or should it react? Now, about the efficient market, if the election result is expected, there should be no reaction on the vote. And the election result is not expected, the market should react. It should adjust, come back to normality relatively quickly. Now, this is for a country. Think of a company. Company is going to get merged. Company A is going to eat Company B. It's going to take over. It's going to take over. And takeover news will be announced on the 5th. Announcement. On the 5th, they will announce the takeover. Company B will announce on the 5th, take a press conference, that Company A has taken over us. If it's expected, if the newspapers, Financial Times, Wall Street Journal, Newsweek, CNN is announcing Company B is going to get bought out, it's been going on for weeks. Negotiations have been going on for weeks, and everybody knows about it. Then when the announcement came, there should be no reaction to it. Market already adjusted to the news. If it's a surprise, then there should be a reaction. But how long is the reaction goes on? Will it go on for weeks? For weeks? Or should it go on just for a few days? When September 11 took place, September 11, I'm assuming everybody was born by then. That was those kind of events nobody can predict. A handful of men knew what was going on. Market reacted extremely negatively. The US market shut down for a few days. But within 10 days, less than 10 days, people don't realize this, within less than 10 working days, market is back to normal. So the extreme thing, market is back to normal within less than 10 days. The US market didn't open for 3 weeks, I think, because the stock market of the US is Manhattan, and that's what got destroyed. Event study looks at that. Now, event studies are very extensively studied, master's level, PhD level. But you have to have, to have a good event study, you got to study a good event. Any boring event is not going to make it. It has to be an event that will have an effect on that particular company. So tax laws change, announcement by government, that is an event people study. And that doesn't usually show anything, simply because when laws are changing, in this, especially in the Western country, they are debated blatantly and openly. So even before it's officially announced the tax laws are changing regarding business or land law or property or something, or foreign investment or something, people know what's going to happen. It comes out open. But events that you have no clue, nobody does. That is the only systematic risk we have to worry about. Something that's going to change, but that's been debated among the government employees, employers, government, long time, and you read in the newspaper all the time, and newspaper announces it before the government does, there should be no reaction when the official announcement is made. Same thing with mergers, same thing with elections. Somebody in this room did a research one time on World War II. And because when World War II was taking place, all the stock market in Europe was shut down because everybody was bombing everybody. Same thing in the Far East, everybody was bombing everybody. Even though America was fighting in both fronts, American market was open because nobody was bombing America. Nobody bombed America. Atlantic and Pacific Ocean make sure of that. Stock market was going on. And that paper, what was studied was, as each battle was being fought, Second World War had many famous battles. Pearl Harbor, when Japanese bombed Pearl Harbor, American base in Pearl Harbor. Leningrad, Battle of Leningrad, when Germans invaded Russia. Surrender by the Italians, surrender by Germany, the Hiroshima bomb, the Nagasaki bomb. But these things are secret. Ordinary people don't know these things. Nagasaki bomb, Hiroshima bomb, Pearl Harbor, very few people knew what was going to happen. And they kept it very quiet. Next day, what was the reaction of the Dow Jones stock market in the US? Because war was depleting business to some extent. Some business was thriving, but most businesses in Europe and America had to be stopped to a large extent. Resources were limited. Resources were being used for war. So every time the Allied forces, which is the Brits and the Canadians and the Americans, every time they won a battle, Dow Jones reacted positively. Because it was a signal the war will come to an end quickly, back to business soon. But every time the other side won, the Germans, the Japanese, and the Italians, the Dow Jones reacted negatively because that means the war would be prolonged. Now, some things, it was expected the Allied forces will win. The invasion of France, but that was in the news non-stop. That sometime soon, June of 1944, the Allied forces will land in France. You've seen movies, D-Day, Normandy, and all that. That was on the news constantly, that this summer it will happen. Even the Germans knew it will happen, everybody knew it was happening. Then when that finally did happen, and in 3 weeks when they did win in France over, there was no reaction, because that was expected. And when the Hiroshima bomb was dropped, there was a huge positive reaction. But when Japan surrendered 4 days later, there was no reaction, because they knew Japan was all finished by then.
How surprising.
So market reaction, efficient market. That's one way to study the event study. Okay. And like the gentleman says, one of the most studied topics is anomalies in the stock market. Anomalies are departure from the normal trend. Anomalies can create a pattern in the stock price. And anomalies gives the investor the chance to earn abnormal return consistently. And two of the main anomalies that people study are the weekend effect and the January effect. So here we are. and then Monday. 9 a.m. 4 p.m. That's the weekend. No stock market is open on the weekend. Bless you. No stock market is open on the weekend. Everybody shuts down here. When it's UK, they're shutting down. Of course, the US is still open for a few more hours. New York is 5 hours behind. So, hour 9 p.m., even the US is shutting down. Japan is ahead of us, 8 hours, so they already shut down. So there is at least few hours, 36 to 48 hours, when the markets are shut. There is no announcement. Government and companies don't like to announce things on the weekend. Unless somebody declares war or something, that's a different story. The standard stuff, they don't like to announce on weekends, Saturdays or Sundays. It's been noticed consistently that Monday the returns are lower. It's been announced, it's been noticed consistently. Monday morning, 9 o'clock, and 4 o'clock, the price PM over here, and PM over here. Monday, Friday, PM is always less than PM. Consistently. This is a weekend effect. Why? People say because news collects, people wonder, lack of information makes investors scared. Now, if that's true consistently, then how do you make money on that?
Short.
If this was consistent every weekend, and as an investor, how would you make money on this thing?
Short.
Pardon?
Short sell.
You can. Yes. Sell and then buy. Sell and then buy. Sell Friday, buy Monday.
Derivatives.
Derivatives. It's very stocks. If it's consistent. Remember that. Remember that when I talked about different types of order, stop order. There's a order that you can take, you can tell your broker to buy at the end of the day or beginning of the day. This was the first week or 2 weeks, I forget. The different types of stop order and all that different kind of orders we talked about very briefly. One order was you can tell your broker to buy end of the day and or buy at beginning of the day. You can do that. Tell him to sell and then buy back. Same stock. Sell, buy back, sell, buy back. Now, how do you study this? Does anybody know regressions? Nobody knows regressions.
You can do them by hand. On Excel, they're easy to do.
Yes. By hand. One way, and some of you will, when you take the econometrics course, anybody taking the econometrics course next semester?
No,
Or is this semester?
I took it before. Don't
Well,
we
you
use
did before.
data?
One way to study this is look at the returns each Monday. Each Monday, each Tuesday, each Wednesday, each Thursday. You can get the prices like that. Look at the change in the prices. If Monday is consistently low, and look at the individual prices. And one way to do this is have a regression. Regression is a way to look at relationship, statistically to look at the way a relationship between 2 or 3, 4 or 5 variables. See if what is the relationship between x1, x2, x3, and x4. To see how x1, x2, x3, x4, how these guys are affecting this guy at the same time. To see the effect of x2, x3, x4 on this chart at the same time. And if you take the quantitative finance course next semester, and I hope you do, because it helps a lot in your dissertation. So I supervise 10 dissertation every year. The ones who will not take the quant course, you can see how they struggle, but still do okay. And the ones who have taken the quant course, either this semester, next semester, I forget which semester it is, they have a much easier easier way. Remember, in your dissertation, not the assignment, this is not for assignment, in your dissertation, a quantitative dissertation brings higher chance of higher mark. If you just go blah, 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 without any numbers and results that you present, present, it's very difficult to give a high mark. But if you go say, I tested this model by this method, this is my data from data stream of Bloomberg, this is my results, this is a graph, look how nice I am and how pretty I am, blah, 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 you get a good mark. You get a higher chance of getting a good mark. So when you, next semester, so one way to do this is look at the regression between, say, return, Monday, Tuesday, Wednesday, Thursday, and Friday. And that's the error term. These are dummy variables. They basically represent Monday, Tuesday, Wednesday, Thursday, and this is the return. And you see how this alpha is negative consistently and significant. That means the effect of Monday is negative consistently. Should not be. By efficient market, should not be. Should not be true. Seasonal pattern is inconsistent with efficient market. Seasonal pattern is inconsistent with efficient market. Should not be consistent. What is the January effect? Anybody know? January effect. It's been noticed, based on monthly data, that January is very good for years for the stock market. Consistently, stock return is high in January compared to December. Consistently very high in January. Now, weekend effect still exists. People still find evidence of weekend effect. But the January effect has somewhat disappeared. And January effect was only consistently true for the US. It was hardly ever found for UK or other countries. And that was the mysterious part, why in the 1970s and 1980s, the January effect, the return on the US stocks was higher in the month of January than December, consistently, year after year. Year after year. Till now, for some reason, the results is much weaker now, but for the UK and other countries, it was really never found. Anybody has the reason?
New Year's resolution. Investing in stocks.
But that should be happening all across the world, isn't it? New Year's is the same for everybody. So if US citizens, US investors are making a resolution, but not the rest of the world. Interesting. Could be. Who? Tax was the reason given. Because the US tax year ends December 31st. All tax returns, all tax forms have to be submitted to the Inland Revenue of US, the tax department, by end of the year. Companies, people, animals, whatever. But for UK, that's not the tax year. What is the UK tax year? April 5th. April 5th is when the tax return has to be done. October 31st, all tax forms, hard copy, have to be submitted in the UK. I just submitted mine last week. Huh. I'm depressed now. And online is January 31st. Now you can do online, of course. US is still hard copy and online is December 31st. But some countries in the Europe also have December 31st. I think Germany is December 31st. Anybody from Germany? No, December 31st? In June somewhere, right in the middle of summer. They spoil the summer right there. And because US is January, they say because of that, it has an effect. Companies have paid their tax. They have dividends to pay now. Dividends come in January. Once the tax is paid, corporate tax is paid by the companies, they have money to cough out the dividends. Stock returns. Remember the formula for price of stock? D1 divided by 1 plus R is be one is suddenly big in January every year, the return price is going to jump. Once you pay the tax, you are left with money for the stockholders. And stockholders are getting paid in January. Christmas just went. Christmas just went.
Does that mean in the UK the taxes that they increase after the tax returns are filed?
In UK, they try to look for the April effect. Have people found that? Some have, some not.
I think in Germany everybody talks about the end of the year effect, so that at the end of the year prices will increase.
Well, there has to be a reason for that. You know, just because it's the end of the year, it's not, you know, it's not Christmas. Some people say Christmas effect, you know, things like that. You know, US they found the reason was taxation, but lately it's disappeared. Maybe because companies are not paying that much dividend the last 5, 7, 8 years. You know,
Maybe
so
the end of the year effect comes because there are so many days when the market is closed because it's Christmas and it's days when the market are.
but then the return should be lower. The return is actually, you know, I mean, market is closed what? Christmas Day and the day before? 2, 3 days, something like that. And then January 1st, I think December 31st they're open. January 1st they're shut and then back to January. 4 days of absence cannot have a high reaction like that. So it's difficult to, you know. There's something to study. The last one, the small effect, the small size effect. Small companies measured by total market value seem to show higher returns. Small companies based on market value, you know, capitalization, seems to consistently show higher return. That shouldn't be happening. The size of the company should not make a difference. If small companies show higher return consistently, then as an investor, you will do nothing but invest in small companies. Heck with the big companies. IBM will go to hell. If the local company is giving you a higher return consistently, if they are off the security market line all the time, then why should anybody go for big companies? That shouldn't happen. Small companies based on market value of the firm, total capitalization, seems to show consistently higher return. That's true in US and Europe. Are they riskier? That's the reason they give. People give, because the beta is higher for these guys, they will give consistent high return. Small companies have a higher chance of disappearing than big companies. Big companies are safe. The betas are lower. If your beta is lower than the market, what is the market beta?
1.
1. If your beta is 0.7, which is you're more safer than the market, you will give a lower return. Your return will be less than Rn. And if your company is consistently higher beta, of 1.5 or 1.3, you're giving more risk in the market, then consistently, by theory, you have to give higher return. But the problem then is, if your beta is high, your return is high, but does that mean you're off the security market line? If your beta is high, right, you're off the security market line. Return. Company A, company B. Large company, small company. If your beta is higher, you just move along the security market line. You're not going to be off. But why are these guys, small guys, are off all the time? That's the mystery. If your beta is high, you're a higher risk firm, then you pay higher return. Fair, true. Based on security market line, but then you move up the line. Some guys big and safe, IBM, British Airlines, the beta is low return, but then they move down the security market line. But these guys consistently give higher return. That means they're off the line. Any questions? Okay. That's our last topic. capital and capital structure policy. When we say that the required return is on investment is 10%, what does that imply? If I say to myself that if I buy this stock, I want a minimum of 5% return. If you say that you will buy this house or buy this business, but you want at least 10% return on investment, what does that mean? If somebody says to you during conversation that I'm not buying this business, or I'm not buying this share, or I'm not buying this stock, or I'm not buying this house unless I get a minimum 10% return. What does that mean? You hear this all the time. The firm or the person must earn 10% of investment just to compensate its investors for the use of the capital needed to finance the project. When you put money in a stock, or when a company takes stockholders' money and put in an investment project, they have to compensate the people whose money they're borrowing, or the money they're taking, and tell them, look, this return will be at least 10%. Is that good enough for you or not? If not, goodbye. Yes, let's play. That's compensation you take. If you don't take money out of your pocket, out of your bank account, and put money into a stock or bond or business of some type, the return has to be a certain amount to your satisfaction. That is the required rate of return. When you buy something for your own consumption, whether it's food or phone or computer, you don't check the return there. If you go buy the new iPad Pro that's coming out in a few weeks for your own use, you don't look at the return. That's for your own consumption. If you buy a house, big house, to raise your family, you don't worry about the return there. That's for your own consumption. But if you buy the house to start a business from it, then the return has to be expected. And that's the minimum required. Either when the firm is investing into a new factory in China or Egypt or India, or whether you are buying stocks or bonds. Both parties, whether it's a big firm with thousands of employees or just yourself. If it's a business investment, then you have to require return. That's the minimum you want for giving up money for that use. In such a case, 10% is the cost of capital. If the investment is risk-free, which never is, then the cost of capital is risk-free rate. Okay, capital structure. Capital structure is a debt to equity ratio. Debt equity ratio. It's a ratio, it's a percentage. Ratio is always a percentage. What is the debt of a firm? It's the borrowing by the firm. This is mostly done by means of bonds and loans from the bank. This is the amount borrowed by the firm. This is not their money. This is somebody else's money they have borrowed. This is the bond they sell. This is the bank loans they take from the bank to do investment. We all have that. You may have borrowed money for this education. That's your debt. My mortgage is my debt. Till I pay the credit card each month, that's my debt. That's your debt too. The moment the credit card bill shows up, there's a debt right there. Till you send a check or pay online, the debt is clear. That's the money that you have borrowed. Every time you use your credit card, you're using debt. It's not your money. It's a credit card company. That's why it's called credit. They're giving you the money to use for the time being till you pay it back. Whether you pay back all the amount, one go, or whether you pay little by little each month, like mortgage payment. That's money that belongs to somebody else, but you have it. That's debt. We're talking about this is the bond. Equity is the ownership of the firm. This is mostly done by means of selling shares or based on savings. Whatever income you earn in your bank account is your savings. That's your ownership. Your house is your ownership till you pay it completely. That's your ownership. For firms, it's equity, shares. When they sell shares, they're selling ownership. I own a bond, I am a debt holder. He owns a share, he's a stockholder, he's the owner. Plus, company has saving also. Companies have billions in savings and retained earnings all over the world. Those are the equities. And the ratio between that, the ratio between the in pounds and in pounds. This is in pounds. The debt in millions of pounds divided by the equity in millions of pounds. And that gives us the capital structure. Cost of equity. you that. What is the main problem with cost of liquidity? It cannot be directly absorbed. There's no coupon rate. We talked about this. There is no coupon rate. There's no coupon rate. There's no rate of return on the shares. When they send you the piece of paper, it gives you the ownership certificate with the ownership certificate of your shares. Whether you own one share or 1,000 shares or 1 million shares, you get a piece of paper saying that you are the legal tender owner of 1,000 shares in British Airlines. But that piece of paper does not give you what percentage is your dividend or what is the rate of return. They don't give you that. You, in your head, you may want 10%, but that will not say 10%. There is no written rate of return. So given that, how do you estimate? Cost of equity has to be estimated. Unlike debt, bonds, if you remember, something we did 3 weeks ago, bonds have coupon rate on them, a coupon payment, a guaranteed payment every month or every 3 months or every 6 months. And because of based on coupon payment and face value, we get the coupon rate, which is the rate of cost of equity on debt, on bonds. But this guy is purely random. Purely random, and we have absolutely no clue what the rate of return is. So this has to be estimated. How do you do that? Remember this guy? Anybody remember that? Long time ago. Nobody remembers that? Remember that? That's the dividend times price today, dividend today, multiplied by 1 plus G, R minus G. What's G? Growth rate of the dividend. We've done this equation one before. We've done this equation before. This has been done before 3 weeks ago. Just coming back to that. Price of the share today, dividend